We have a hugely important week ahead of us, both top down and bottom up. On the macroeconomic side, we have no fewer than 3 central bank meetings. The Bank of Japan comes on Tuesday the 31st of October, where the consensus is that Governor Haruhiko Kuroda will leave policy unchanged. That means a headline interest rate of minus 0.1% and a quantitative easing or QE programme of 80 trillion yen or £530 billion a year. Japan, just so you know, has had an interest rate below 1% since 1996 and it still can't generate the growth or inflation it wants, which is why no Western central banker wants to turn Japanese. Then comes the US Federal Reserve on Wednesday the 1st of November. Chair Janet Yellen's expected to leave interest rates unchanged at 1 to 1.25%, but tee up a third 1/4 point rate rise of this year for the December meeting. Remember that from the 1st of October the Fed was due to start winding down its QE scheme at an initial rate of $10 billion a month. And then last but not least, the Bank of England on the 2nd of November. Governor Mark Carney's dropped some very heavy hints that we might get the first rate rise since July 2007. Now that would be some turnaround after a 7-2 vote against a hike last month, and nothing much has changed in the meantime, so personally I'd be surprised. However, I've been wrong before, and the governor has promised a rise and then failed to deliver so often before, he may lead the Monetary Policy Committee to sanction an increase this time just to maintain the bank's credibility. If he does, maybe the message could be one and done. One rate rise to offset the cut of August 2016, and then steady as she goes. Now this may all sound a bit esoteric, but it's important stuff. Throw in the Swiss National Bank, and our research suggests that the Fed, Bank of Japan, Bank of England and European Central Bank have poured $11.5 trillion into the global system, partly with the intent of creating a wealth effect by juicing asset prices using QE. As this chart of the aggregate balance sheet in dollars and the FTSE All World Stock Index shows, they have goosed share prices, but whether it's created a wealth effect is a lot less clear, as the debate over global inequality suggests. And if they have goosed share prices by injecting QE, what happens when they stop adding to it or even start to withdraw it? This could be a key test of the stock market bull run, which began in early 2009. Now, as if that trio wasn't important enough, we've got some big company results and trading statements due as well. They include Megabank HSBC on Monday the 30th of October, media giant WPP and always in the headlines airline Ryanair on the 31st, retailer Next and Standard Chartered Bank on the 1st of November, BT, Morrisons and Royal Dutch Shell on the 2nd, and to round things off, orthopaedics and wound care specialist Smith & Nephew on Friday the 3rd. And that's interesting because the company's now got activist investor Elliott on its tail. Now for all of that, the stock that I think is most capable of causing a fuss when it reports its third quarter results on Tuesday the 31st is BP. I know this is an important one for you, not least because BP is the third highest payer of dividends in sterling terms in the FTSE 100, and it's forecast to be the 8th highest yielding stock in the index this year, as per this chart. One thing that may be going BP's way at last is the oil price. Helped by military strife in Kurdistan, supply discipline from OPEC and Russia, and a steady drop in American oil inventories, Brent crude's trading near $58 a barrel, compared to barely $50 a year ago. As we can see here, BP shares are a bit of a slave to the oil price, which I guess makes sense, at least in the short term, although the company's cost-cutting and efficiency programs can help it to maximise its returns and minimise the downdraft when prices rise or fall. When it comes to the third quarter figures, BP will steer you toward looking at the replacement cost profit before tax, which excludes the change in value of inventory to try and smooth out some of the effect of movements in oil and gas prices. In the third quarter of 2016, BP made a replacement cost profit of $1.6 billion. You might also want to give the company the benefit and look at the adjusted replacement cost number as a benchmark. That was $1.2 billion in Q3 2016 and $2.2 billion in the second quarter of this year just gone. This graphic shows the quarterly progression for both numbers going back to early 2013. Beyond the headline figures, keep an eye on the quarterly dividend, expected to come in changed at 10 US cents, and comments on net debt and cash flow. Remember, BP's dividend comes to around $1.5 billion a quarter and capital investment some $4 billion plus. Cash flow, defined as, wait for it, operating profit plus depreciation plus amortization minus working capital minus capex, has not covered the dividend since Q4 2014, as we can see in the final chart. Now that's why the firm's selling assets, cutting investment and raising debt to pay the divvy. but that's not necessarily sustainable in the very long term. So the higher the oil price goes, the better the cash flow, the safer the dividend for the long run. Thank you for watching, and I look forward to seeing you next time.